Here's a chapter outline for chapter 4. We'll begin by looking at uptrends and downtrends in stocks, followed by market moving sideways, why are trends important, drawing trend lines, false breakout, and finally the sum up of the lesson. So to start this lesson off, I want to show you a chart of JP Morgan from 2012 to about 2014. Now here you can see that JP Morgan was trading at about $30 a share in June of 2012, and it went all the way up to almost $60 a share in January of 2014. Now if you had got in on this move, you would have made almost 100% of your initial capital. So if you had put in $10,000 and bought JP Morgan, at the end of this uptrend, you would have almost $20,000. Now would it be great if you could spot a strong trend before it develops, or as it is developing, and get in and ride the trend? Well, in order to do that, let's first take a look on how to define a trend. In the markets, there are two kinds of trends, uptrends and downtrends. An uptrend is defined by a series of higher highs and higher lows. So what is a higher high? A higher high is when the current high, which is the newest high that was just formed, is higher than the previous high. And a higher low is when the current low is higher than the previous low. So the most recent low that was formed is higher than the previous low. Now downtrends are defined by a series of lower highs and lower lows. Now a lower high is when the current high, the newest high that was formed, is lower than the previous high. So you can see that this current high is lower compared to the previous high. And a lower low is when the most recent low that is formed is lower compared to its previous low. So this is a lower low. So this is how you define uptrends and downtrends. Uptrends are defined by a series of higher highs and higher lows, whereas downtrends are defined by a series of lower highs and lower lows. Of course, the market doesn't always have to be trending. It can also be in what we call a sideways pattern. This refers to when the market is moving as if it were in a range with an upper and lower level. Now market moving sideways are quite common, and you can expect to see this occur about 50% of the time. This happens because the bears and the bulls are still fighting for control, and neither side has been able to take over and exert their control on the markets. So why are trends important? There is a saying that it is best to trade with the trend and not against it. Now people say this because trading with the trend is easier since all you need to do is follow the trend. A strong trend is like swimming in the ocean with currents and waves, and following the trend means the currents and waves are on your side. And this makes it easier for you to get to your destination because you have to use very little force, and the current and all the waves will push you along. But if you are trading against the trend, it is as if all the current and waves are against you, and you are trying to swim against them to try to get to your destination, which is very difficult and it takes a lot of effort. Trading with the trend is easier since all you have to do is to catch a very strong wave and you can just follow it all the way and it will help you arrive at your destination. Just like what we've seen a couple of slides ago with JP Morgan. Now I'm going to give you a tool that can help you identify trends. We're going to learn how to draw trend lines. There's another technical indicator known as moving averages, which is very good for following trends. But for this chapter, we're going to focus on trend lines first. I'll cover moving averages in the next few chapters. So to begin, what are the benefits of trend lines? Well, 1, it makes it easier to identify trends. Second, trend lines can help you gauge on how strong a trend is. And third, trend lines can act as support and resistance. Support and resistance is a very useful tool that can help you when reading the charts. Now this will be covered in the next chapter.